Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Hey everybody, and welcome back to Wealth Unfiltered. I'm Samantha Parinello, and I am your host. I'm joined today by my resident guest expert, Chris Parinello. Welcome back.
Thanks. Happy to be here.
So today we have a powerful episode for you all. We are doing an episode on investing like a billionaire. That's right. We are dissecting the strategies of the ultra wealthy. So to get started, studying billionaires is important for every type of investor, whether you're a novice investor or a seasoned investor. Today, we're looking at timeless principles that create and sustain massive wealth. The first is the long-term approach, the long-term thinking. Billionaires do not chase the quick fix. They play the long game. So investors who are looking for wealth are looking for compounding over the decades. So a perfect example of someone like this is Warren Buffett. Warren is worth over $155 billion. And his average investment hold time is 20 years. Which is incredible. I mean, most investors, I think, feel like 10 years is a long time, 5 years is a long time. But Warren Buffett's average time is 20 years. In fact, his favorite saying is that the hold period he loves is forever. So I think that speaks volumes to how this strategy is extremely important for people who are trying to build a massive amount of wealth, do it over the long term, and truly play the long game. So as we talk today about building wealth and the first principle of the long-term approach, what I'd like you to kind of, grow upon is the differences between a long-term approach and a short-term approach.
No, absolutely. I think, with the people that you mentioned that we're going to talk about, the common thread is they all had, as they were building their empires, an enormous amount of, with the exception of maybe. And when you're talking about the long-term approach or the long-term time horizon, I think it's pretty common. Everybody who studies investing understands there's a time value to money. But the real answer to the difference between a long-term approach and a short-term approach is the idea that you can use tools like diversification to mitigate your risk and understanding that things aren't just going to go up. So if you're looking at something with a 10-year horizon, a 20-year horizon, a 30-year horizon, like when Warren Buffett was building Berkshire Hathaway, you really see the value in studying historical trends. You see the value in looking at underlying fundamentals. And the opposite approach would really be, like to give a really egregious example, would be like the meme stocks. You know that there aren't the underlying fundamentals. It doesn't really make sense why a lot of these values were being driven up, but because of people participating and buying up the stock, they were going up. Who am I to say it was a bad investment if somebody bought in at $1 and sold at 150? There was a way to make money there, but the piece that was ignored was risk. And at the heart of every rational investment approach is risk mitigation. And that is what gives you a long-term strategy.
Amazing. Yeah, absolutely. So I think you actually just naturally took the next principle from me, but I love that because it's a great transition here. So they say that obviously diversification is one of the other fundamentals that you must, employ into your portfolio and your investment strategy. But they also say like understanding how to diversify it and make it not risky and have asset allocation, like very, what's the word I'm looking for? Like where you like intentional and making sure that you're doing it that way in order to like grow your portfolio, but also to mitigate the risk. So one of the things that they talk about with Warren Buffett is that he has always avoided technology. That's just something he doesn't really feel comfortable in. But the funny part about that is that his most successful investment was a $1 billion investment into Apple. And that turned into over 150 billion over time. So I think that speaks volumes to why you diversify, maybe why you do something that makes you uncomfortable, but to kind of not only stay in one wheelhouse and to make sure that you're evolving and changing your investment strategy. So there's another investor who I want to talk about here, Ray Dalio, and he has an all-weather strategy for his portfolio. So I'd like you to dive into that for me.
Yeah, I think what's really interesting about Ray Dalio, who, he created, probably the most successful hedge fund. So understanding what a hedge fund is, why they were created, kind of gives you a glimpse into what he finds important. And what he finds important is diversification. And, if you're focused only on real estate, you might think diversification is two different areas, or you might think it's two different asset classes within real estate, multifamily and industrial, or hospitality and manufacturing. But what Ray Dalio really preaches is 15 uncorrelated lines of wealth creation, something like that. I don't know if the number is exactly right, but the idea would be that you build a portfolio and you construct a portfolio with multiple income streams in multiple continents in, areas that have different levels of perceived risk. The important piece to his theory is the uncorrelation. So to give an example would be, if you were really focused on multifamily investing, and this is something, I work for a multifamily firm. This is where we're focused. I can see where some of the risk didn't play out. And you were just putting all of your money in multifamily in 2021 and 2022. It proved to be a very frothy market, and you were buying at a high basis. A lot of those deals are really challenged right now. Huge runway if you can keep those properties solvent. But nonetheless, if all of your money was there, you might be looking at an uncorrelated disaster where you didn't get to take advantage of some of the upside in other areas. Now, if you had 20% of your portfolio in alternatives like real estate, and you had 20% of your portfolio in traditional equities, and you had, a good mix between stocks and bonds, and then maybe you had different real estate markets around the world, and then you had a good hedge or a store of wealth like Bitcoin or gold or copper. You get into a point where what ends up happening is when one industry is suffering, usually there's another one that's doing really, really well.
Okay.
And his big theory is that if you construct a portfolio, and he has like a nice little quadrant that he'd show, if you look him up and you see you basically diversify to where no matter what happens in the world, you're hedging against one having a downside. So to further take advantage of that system is if you build a portfolio properly based on those principles, as you see the future unfolding. So when you notice that real estate was frothy and prices were very high, if you could actually make that determination, you could kind of take some of your winnings, because that was a great time to sell.
Right.
People made fortunes selling in 2021 and 2022. If you take some of your chips off the table and then you put it into the stock market, or you put it into another uncorrelated stream because you're thinking, okay, I see the writing on the wall, like they're not going to get much higher than this, then you're able to take advantage of some of the swings in the market. Like, I feel like right now, real estate's in a rebound position. You've seen some pain there, and now that pain is turning into opportunity, and that opportunity is going to turn into even greater opportunity. But I look at traditional equities, especially, the Dow Jones and the NASDAQ, and I say, oh, maybe this is a little bit overheated. And you see it. Like, you see Warren Buffett, you see Ray Dalio, you see a lot of these people screaming from the mountaintops, redistribute some of the wealth that you have in your portfolio, maybe even hold a cash position. But put it in places where there's more opportunity, because if you only focus on one income stream and that income stream gets disrupted for whatever reason, you're taking on way more risk than you need to.
Yeah, we're seeing a lot of millionaires, billionaires, just like the Wall Street investors pulling money from assets or, stocks that they don't believe that the fundamentals are going to continue to rise, and they're either holding for something coming in the future, an opportunity, or they're already reallocating them like at this moment. So I think it's super interesting watching that stuff. I definitely had a time where this was something that I thought was not interesting, even a little bit to me. And I would say probably in the last 5 years or so, I have grown to very much follow it alongside you and dive in and really kind of do what we're doing here, where we start to look at the big players and see what they're doing, not because we feel like they're the end all be all, but people who are extremely successful as investors probably doing something right.
Yeah. And over time. So you're going to make mistakes. Any of these big successful investors, if you go back long enough, you're going to figure out where they created their prowess and their ability to navigate cycles. And it usually can be pinpointed to a bunch of massive mistakes that they made and learned from. And that combined with the idea of like the scientific method, where you have a theory, you think it's going to work, you try it, you figure out what went wrong, you iterate on it, you come and then you come up with another hypothesis, and you're like, okay, like I learned these things, let's try this out. And over time, there's a correlation to most of the billionaires, most of the successful investors are in their 70s and 80s. And a lot of that has to do with what they were taught, what they grew through growing. Like my dad, for instance, the lessons that he taught me from being born in the 1930s, like he lived most of his life with the damage and pain from growing up in that era, and was really focused on saving, was really focused on protecting against the risk of not being able to feed your family. Today, a lot of people have only been through the good times. So I always think it's great. Why I was really excited for this episode of the podcast was you will certainly learn from your own mistakes. But you can also learn from other people's mistakes. And there's lots of people out there that put tons of thought leadership and show you the historical cycles that they've lived through or that they've studied to help prepare you to make better decisions today.
Yeah, absolutely. So we've covered the long-term approach and diversification, which are probably two of the, I say, core fundamentals, the foundation for the investing. But now we move into the third, which is one that I feel like a lot of times people probably don't fully understand it, but also if you don't do it right, it could really take you into a very poor strategic path. So we're talking about owning and renting your wealth, which that really means billionaires own assets. They own businesses. They own intellectual property. They own things where there's a passive income stream that comes back to them. And a perfect example of like something like this, an example of what we're talking about here is Elon Musk. So since 2019, he's not taken a salary. So the way that he has built his wealth is through having the shares of Tesla pay him. It's a compensation package that he's created. So his wealth and success is directly tied to the performance of Tesla. So when he basically had, I think they said the number was like $56 billion was what he had as his compensation package. And just short, like I think we're talking a month after Trump went into office, the new estimated amount because of the Tesla shares and stocks going so high is $101 billion worth of compensation that is owed to him. And what that means is that he has the ability to just grow and grow and grow. It's like exponential, right? So what I want to ask is to you is what are other examples that you can bring to the table? And also, why is passive investing and passive income such an important way to create long-term wealth?
Yeah, I mean, I think, a lot to unpack there.
Yeah.
First, I think Elon Musk's success and what he's created by a structure like that is alignment. So I think no matter what you're doing, what you're investing in, especially if you're going to be doing it passively, what you're looking for is an alignment with the person that's in control and that is the active investor that you're passive to. So and this goes back to human nature and how to figure out if you want everyone's motivations to be aligned. So if I am a real estate sponsor and I have a bunch of passive investors, they want to know, like, it needs to either be lucrative for me, or it needs to be, I have my a certain amount of skin in the game. There needs to be a reason for me to work really, really hard, because that's essentially what people need in order to get through the hard times to the good times. So when you have a compensation package structured around the success of your stock price, and you're getting paid in additional compensation from stock, you really incentivize the people to care about the company and the company's overall success. And Tesla and Amazon, and
I was just going to say Amazon's a good example
within
of that.
the tech industry, this is a very common structure where a lot of people will get paid and will get raises based off of a reasonable base salary that protects their cash inflows. But then their growth is through getting stock shares and vesting plans that allow them to participate in the growth of the company. And that's a really great way to build what I think is most important in most companies, is company culture.
Yeah.
Because if you can tie somebody's work ethic to the company's success, and they succeed when the company succeeds, then you get more productivity, you get people to actually care about what they're doing.
Yeah, absolutely. I mean, I think you're touching on something that's really important as well. But I will, and that is having the buy-in from your people in your company, the workers, obviously will then create a stronger performance and then your ultimate wealth. But when we're talking about specifically about building wealth as an investor, specifically one like who owns the company, I would say there's a couple of like strong things that come from having the passive income and to help you create your financial freedom, like having steady income stream that is something that doesn't take your time, right?
Right. And that's the holy grail, right? Like when you talk to really high earning professionals, people that make 500,000 to several $1,000,000 a year, what they're chasing is, how do I continue doing that? Let my money work for me so I can retire when I'm 50. So I can enjoy spending time with my family. So I can have some of that time freedom back. And the real answer is, you need to learn about different investable assets, build that diversification, and get enough knowledge and really learn how to build the relationships with companies and opportunities to safely invest your money with other groups that have a big growth trajectory. So like all of the companies that you're evaluating from a stock purchase perspective, or, participating as an LP with a real estate group, what you're trying to determine is if they are going to be able to have the productivity and the growth in the future. And when you make an investment, what you're doing is you're buying future growth. That's essentially what you're doing. So what you're doing when you're making a decision on what you're going to invest in is, where's the growth going to be? And I think that that's a good starting point for building a portfolio, is let me figure out 10 things in the future that are going to be part of the growth. How long is it going to take to get there? And then you start trying to really dive into the data to figure out when the growth is going to happen. How patient are you going to have to be? Because saying something very general like, well, I know there's going to be growth in AI, so I'm just going to invest in everything AI. Well, there's thousands of different ways to participate in AI. What you need to kind of pinpoint is which groups are going to have market share, which groups are going to have the fundamentals, which ones are going to have the relationships to actually participate with who is going to drive that growth. What is the government and the administration for the next 15 years going to look like for regulations and all of that? Like there's a lot that goes into it, but the more that you dive in, the more you can see opportunity. And just remember that if you're taking a bigger risk, you're usually getting compensated for it. So chasing alpha and your entire portfolio being focused on alpha is a way to feel like you're just at the casino gambling. You need to have beta in your portfolio. You need to have gold in your portfolio. You need to be able to protect yourself against downside risk. and understand that when something goes down significantly, it's a buying opportunity, not a selling opportunity.
Yeah. Well, and so for passive investing too, I think another really great piece to that is that you can have multiple income streams. You can own multiple businesses. It gives you, when you're no longer trading your time for money and your money is doing all the work for you, then you have the ability then to have multiple income streams. You can have multiple businesses that are income generating, right? So I think that's such an important key piece to how these people are creating wealth, is because they don't have a 9-to-5 job that's their only source of income.
Right.
They have so many sources of income bringing money to the table, how their wealth is building and compounding over the decades. And that's the test of time too, right? You talk about market cycles, you were talking about the ups and the downs, but the reason why they can do that is because, like you mentioned, when one isn't going well and maybe that income stream is no longer there, but the money's still sitting there waiting, it might have gone down, there's another one generating. And the ebb and the flow is like how they have mitigated all of that risk and then built the massive wealth that they've created.
Well, and another kind of, I think, observation about Elon Musk, and one of the folks in the industry as far as scaling companies and multiple income streams that I follow. I think he's a marketing genius, is Alex Hermosi.
Yes.
And one of the things that he has observed, and I think is extremely relevant, is eliminating key man risk. So a lot of people want to own a bunch of companies, but then they also are so wanting to maintain control of everything that they can't eliminate their reliance on being in the company. And that's something that Elon Musk has done really well. Like, he set up Tesla, he set up the Boring Company, he set up SpaceX, he does all of these things. Now he's running Doge initiatives in the government. Like, he obviously isn't spending 40 hours a week in every one of these companies as the head, pulling all the levers and doing all of the work. You can tell the guy, isn't scared of rolling up his sleeves and working. And you've seen that historically through all of his companies. But identifying how to take yourself out of that company, get the right person in the right seat, and be able to go start another company is how you own your wealth instead of renting your wealth. Because you're no longer trading time for money. You are using your good ideas, your ability to build systems and procedures, and then finding somebody to implement that, and then moving on to another thing.
Well, and you mentioned Alex Hermosi and obviously Layla Hermosi, who are doing that. Can you go into a little bit more detail? Because I think that they are a really good example.
Yeah. I mean, I think, his story is fascinating because he, really well educated. I think we went to one of his big workshops, and he had like an Ivy League education, was going to go work on Wall Street, decided or for venture capital or something, and then decided to basically go into the gym world. It was what he was passionate about. I think he ran into a bunch of failure, learned from a bunch of his mistakes, and then built kind of like a fitness empire that he later sold to private equity. That process of taking something that he built and selling to private equity really spurred an idea.
Like the light bulb went off.
Yeah, he's like, oh my God, like I learned about all of this now. And he's like, this thing that I went through selling to private equity, like I think there is a hole in the market where people, like legacy people that, like say you're 40, 50 years old, you own an HVAC company, or you own your family a funeral home. And you're like, I want to eliminate my position. I don't want to work in this company the rest of my life. My son doesn't want to take it over. My daughter doesn't want to take it over. Right. What am I going to do? So he saw that there was a need for this, and he spun up another company called acquisitions.com. And like they have these workshops where they're literally teaching people how to take their company and prepare it to be sold to private equity. And it's all formulaic. It's not, it really isn't rocket science. It's like, if this is your revenue, if this is your EBITDA, then you need to amplify these things before the private equity shop looks at your financials, because this is what they're going to look for. So build this up, focus on these things, and then you're going to be able to get a much better exit. And he helps a lot of people do those things.
So moving on from passive income, the next principle that we're discussing is leveraging other people's money. And what that truly means is using debt as a resource for your wealth growth. So we have tons of investors who do this across the world, and millionaires and billionaires use this strategically. And I would say the key fundamental here is to make sure you're not over leveraging yourself. You're not creating a liability issue. But people like Warren Buffett, Ken McElroy, and Carl Icahn are purest of examples of people who've used this strategy to create their wealth. So I'm going to let Chris take the reins here, and he's going to really dive into how using debt and leveraging other people's money as like a huge way and resource for creating your wealth.
Yeah, no, absolutely. And the idea of leveraging anything, whether you're using debt or whether you're using equity to add leverage, you're basically creating almost like a lubricant or even like adding gasoline onto a fire. So if you have something that's working and you have X amount of capital in order to invest, and you believe in the fundamentals of what you're doing, you're finding success, you're getting returns. If you can get capital infused into that business through equity or debt, you will be able to 10x, 15x, 20x your productivity, assuming that the fundamentals are there. And some investors, big, well-known, successful investors, have either had a propensity to do that or maybe shied away from that. And I think the juxtaposition is probably Carl Icahn, who really explosively grew wealth using leverage. And then someone like Warren Buffett, who found a ton of success, but he has shied away from leverage. So the conventional thinking, so like if you go back to like based off of when you grew up, like the stories my dad told me, it almost felt like there was a fear of you using leverage.
Yes.
So if you couldn't afford something, you shouldn't buy it. That was a sentiment. In many other cases, like as a real estate investor, you look at it completely different. Every property that Viking buys usually has somewhere between 60 and 70% leverage, which means that the other 30 to 40% coming in as equity. Leverage is really powerful for real estate investors because it's typically coming at a fraction of the cost of your equity. Equity's taking on more risk, they want higher returns. So if you're able to get a 70% loan from Freddie or Fannie at 3.86%, 3.5% when interest rates were a little bit lower, then that portion of the capital stack is really low and it levers up the returns for the equity that's participating. Now, if you can get that leverage from 70 to 85%, in theory, it creates even stronger returns for the remaining 15% of equity because the cost of capital is much lower. The problem is it produces more risk.
Well, but I would say the huge upside of like how that this is like a huge wealth building strategy is because these guys have that money. They don't have to take the debt, right? They don't need to leverage other people's money. But the goal is that then they have more of their own capital to deploy in other investments.
Correct.
So I think that that's a huge thing that people don't understand. They're like, oh, well, I'd rather have that security of owning this thing and then I don't have payments or I don't have to have that like lingering over my head. But the goal would be that instead of buying one house for $1 million in cash, let's say if we're talking about real estate, you could buy 2 or 3 homes for the same amount of money that you would have put in there if you did cash by using the debt, right? So then now you have multiple sources of income because now you have 3 or 4 rental properties, not just the one big house or the one asset.
Yeah. And for our active investors, like most people that are watching this have probably, seen some of these other methods like the Burr method where you're basically buying, you're holding it, you're refinancing it, you're taking the equity out, you're buying something else, and you're building this portfolio.
Mm-hmm.
Great. You're using leverage to grow and scale. And that is a way to build a lot of growth very quickly. The big thing to keep, and not to be a Debbie Downer, but the big thing that everyone has to recognize with leverage is when you lever something up and you take on that debt, the person that holds that debt is also trying to mitigate their risk. So you're usually having to sign a personal guarantee. or have some type of asset protection, or at the very least, the deed or whatever you're trying to buy could all be wiped out if you can't perform on that loan. So while I do recommend using leverage intelligently, I don't recommend getting over your skis and using leverage to grow and not looking at the risk, because it could be problematic for you.
Oh, absolutely. And that's, I think that's the key here, is making sure you're not over leveraging yourself and you're being very strategic in your decisions to use it and creating, the wealth through that, but not, like you said, if you're going to keep taking it out and then it becomes a little bit more precarious, right? So
Right. Well, and think about it from, because we're talking about different folks that have built tremendous amounts of wealth, and you look at the tech industry. When people invest in tech stocks and or venture capital, investors in venture capital, like you might work with a venture VC fund that's going to invest in 20 companies, knowing that 18 of them are probably going to fail.
that's wild.
Those 18 that fail all get made up for the 2 that hit.
Yeah.
And when you dive into the details and you can mitigate your risk and you have the data to support how many of these are not going to pan out, people are willing to take that risk because the growth potential can be explosive.
Yeah.
And you can mitigate your risk by having a portfolio of companies and really understanding. And if you get 5 to hit, then wow, even better returns. So when a company like Tesla or a company like Meta or a smaller tech company that's growing does like a Series A or a Series B funding, they're basically taking their thesis and they're saying, this is the market share we're going after. These are the unicorn type returns that we can create.
Yeah.
And they're going out to a group of investors saying, look, we might be worth nothing if this doesn't pan out. But man, if we can just hit this, if we can capture this market share, we could have 100x return.
Yeah.
And that
Enticing.
explosive return, in many cases, some people are willing to take on that risk. Now, I wouldn't spend my last $100 on a bet like that. But if you have a few $100 million and you have access to VC incubators and tech groups that have found success and have helped companies grow, there's a real approach to investing in those types of companies and getting some of those alpha returns that should be a part of everybody's portfolio.
Yeah. And they said, researching some of these, big investors, the billionaires, it's not just for real estate to use this method, like acquiring other companies and businesses, like you're talking about stocks and shares. And I think that it's important to note that there is a variety for diversification using debt as well.
Yeah, like, well, ask yourself, why do you think that Warren Buffett was normally averse to technology? I think a big part of it was it produced too much risk.
Mm-hmm.
And he maybe didn't want to play in that sandbox unless he saw and really understood what the money was going into and how it could create, these types of like alpha returns. And I think with Apple, it probably became clear to him that this new company with a phone where everything was you basically had a computer in your hand when everything else was a flip phone where you're punching buttons, or you still went home and dialed a rotary, that type of technological shift that was going to disrupt how people lived gave him the comfort in saying like, wow, I think I should be a part of this. I should put a significant amount of money in this, even though I typically don't chase technology.
Right. That's why AI is so enticing for people, because there is going to be one. I mean, it's not going to be all of them, but there will be one that is similar, that changes the way that human beings live their lives and do things. And when that happens and it's the right one, you'll see that exponential growth that Apple saw.
Well, and then there's also a lot of, I think, merit. Like you look at NVIDIA, you look at DeepSeek, you look at some of these companies, like if you can figure out, if you believe in the thesis that AI is going to drive the next frontier of technology and that is going to permeate and disrupt every industry, investing in the things that support the growth of AI is one way to take advantage of AI without figuring out who the major player is going to be. So you're going to need computer chips, you're going to need data centers, you're going to need a lot of these things. You still need to be intelligent about where you're putting your money in those things and where you think the time horizon is going to be. Like if you think that AI is going to take over the roads and you think that 10 years from now, everything's going to be self-driving, cars are going to be going much faster, your typical person that's just driving isn't going to be they're going to be the minority. You could invest in infrastructure of that. You could invest in things like Tesla that have FSD, full self-driving, and robo-taxi and things like that. But just keep in mind that like those technological shifts might not happen as quickly as you think.
Right.
So just because you know that AI is going to be the answer, you think it's going to happen in 5-10 years, you start investing in things today, but those things don't hit or create returns for you for 25 years, then you kind of missed the boat and you lost a lot of time.
But that is why Warren Buffett has 20-year hold period, because he's playing the long game.
Right. Well, it's not like you don't look at these things in isolation. So it's the opportunity cost of investing in something that could hit in 5 years versus something that's going to hit in 20 years. Should you allocate some of your portfolio? Like this is how I look at Bitcoin. Like a lot of people have asked me, a lot of our investors, what do you think about Bitcoin? I think that institutionally, real groups, real hedge funds, countries are looking at this as a store of value. But how long is it going to take for people to really feel like the risk isn't there? And allocate something to it. I wouldn't put 75% of my portfolio in Bitcoin, just like I wouldn't put 75% of my portfolio in gold unless I thought the market was going to crash tomorrow.
Yeah.
If I think the market's going to crash tomorrow and I move a lot of assets to gold or gold miners or things that are going to hedge against a giant stock market disruption, and I'm wrong, it doesn't happen for 7 years and the market keeps going up, then I look like an idiot.
Yeah.
Right? So
that's so true. Well, speaking of downturns and, potential crashes, that brings us to our last principle that we're discussing, and that is investing in crisis. So, billionaires, a lot of them have made their money during financial crisis, recessions, and downturns. So they look at downturns as opportunity. And though not everyone has enough discretionary income or are millionaires and can take this opportunity to the limits, and the sky is the limits, as these types of folks can, there are opportunities investing in the crisis. And a perfect example, again, Warren Buffett keeps coming back around because he is the best investor probably of our lifetime for sure, and probably many lifetimes. And the growth that he's had in using his strategies are really important. And in 2008 financial crisis, he saw the opportunity. He took lower valuations like Goldman Sachs, and he put money in there and saw the fact that, this is going to be worth a lot more when the market stabilizes again. And he made a killing. Yeah. And so I think one of the things when we talk about Warren Buffett is, you were mentioning, we were talking at the beginning of the show about how you emulate some of these people because they're successful, right? And you learn from their lessons, but you also look at their strategies. And we're seeing Warren do some things right now that I think people should be taking notice to. So I wanted you to dive in a little bit onto maybe some of the indicators and things that are going on that we're noticing and why we're following him.
Yeah, well, and I think that you're spot on. And when there's a crisis, the way that I would frame it is it's basically a giant money grab, right? So anytime something gets majorly devalued, and what I think back to, because it's the only relevant time in my lifetime where sometimes I wish I was like 5 or 6 years older. Because when 2008, 2009 happened, I remember for me personally, like my father had been diagnosed with cancer. We were kind of going through legacy stuff, looking at the portfolio. I saw, what I thought was like a large amount of money go to a small amount of money in like 6 months.
Yeah.
And it was scary. And instantly, like at this point, like it's like Google Finance, Yahoo, I just digitized like the portfolio that my dad and I had worked with and was looking at like stock. And I'm like, and I remember asking my dad and saying, I don't understand, like Bank of America, why are they trading at like $4 a share? Like they were like what? And he explained to me what happened. And my just gut reaction was like, we should buy more. Like, we should buy more. Like, we should buy all of it. Like, why aren't we, like, there's no way that, and a lot of people felt like the banking industry maybe was going to fail. Maybe it was too big to fail. Would the government bail it out? Well, the government's shown that when something like this happens, they typically bail out. They typically use quantitative easing. Things will rebound. If you believe that that's going to happen, then the answer was to buy more. And I remember, like, I was in college and I had like a $15,000 student loan or Pell Grant or something that I got. And I was like, I'm going to take 10,000 of this and I'm going to add it to like all of the positions in these stock portfolios. And I did. And it wasn't enough money to like build like exponential wealth. Were you using
leverage, Christopher?
I was. And then I was like, I'm going to not use this. I will like live at home. I will do whatever. But I was like, these prices, like I've always looked at things and have been taught to look at things of value. And if you get something, like if I walk into a store and I see something that I don't need, this is how it hurts. I see something I don't need and it's 75% off. I'm like, how could I afford not to buy this?
Right.
And like, that's how I look at investing. So real estate crash, like people should be out there buying real estate. Like, why aren't they buying real estate? They know that there's supply demand imbalance. Like, obviously it's going, at some point it's going to turn around. You should be go out there buying it. Same thing with a crisis. And I'm glad that that's the way my brain thinks. But what you notice when you research institutional investors that have made billions is like, what's Warren Buffett doing right now? Like, I can't tell you like what the Fed's going to do, what it's not going to do, where interest rates are going to go. But when someone like Warren Buffett starts liquidating positions and taking chips off the table and building more cash reserves than he's ever had in his lifetime, like that ominous sign is he thinks there's going to be an opportunity to deploy that capital and get value.
Right.
How else would you look at it? Like, because cash is historically the worst medium to have your wealth in. It is going to lose value the quickest. He is probably losing value on a daily basis, hedging on the fact that that money is going to come in really handy when something hits the fan and there's an opportunity to buy something at a huge discount.
Yeah, his quote that I love is, "When it rains gold, put out a bucket, not a thimble."
Yeah.
And I think that's a really cool one because it's exactly what you're talking about. He liquidated, I think he sold off 56% of his Apple shares in the last year to basically do what you're saying. He saw that there was going to be economic uncertainty, there was going to be a new president, there's all these shifts happening.
And really think about it from a risk value perspective. He sells right now. He feels like Apple's stock price is pretty frothy. What happens if he's wrong? What happens if a year from now, Apple stock price goes up 10%? The cost of making that move is that he missed on that 10% of growth.
Yeah.
He doesn't believe that it's going to go up 70% like it has while he's held it. So he's taking the risk that he might lose that 10%. But if something happens, if there's some kind of catalyst where there's a correction and 30, 40, 50% is wiped out in a year or 2 years or whenever, that he's going to be able to take that money and buy it and instantly create all of this additional wealth.
Yeah.
And I wish in 2008 that I had access to hundreds of millions of dollars, because like people that I've worked for, people that I've seen that are successful today, shed the fear and said, this is a buying opportunity.
Yeah.
And they built great fortunes during that time frame.
Absolutely.
So, the other quote I think is really interesting, especially as we kind of talk about the Fed and what the Fed's going to do, is Ray Dalio, who we were talking about earlier, has this really funny quote, I think. And everyone talks about like a crystal ball. What's the Fed going to do? Like, what you're looking at the data, you're trying to figure out. There's so many different dynamics at play. I don't even think the Fed really knows what they're going to do. They're really just very reactive.
Yeah.
And what he says is, if you trust your crystal ball, you'll be eating shattered glass.
Yeah, that's a good one.
Really great quote.
I love that too. Well, I will say on that note, because I think it was awesome, is, we're really hoping that this episode is powerful. I mean, I feel like it's really powerful. It helps me kind of rethink about how we're investing, why we're investing, our strategy, and our wealth growth trajectory. And so just to recap on the 5 main principles here, we're talking about long-term approach of thinking and investing. We're talking about diversification, asset allocation, and mitigation of risk, basically. Owning versus renting your wealth, leveraging other people's money, and then investing in crisis. And I think if you can create a portfolio and a strategic investment mindset, that those are the core fundamentals that billionaires are doing, then why aren't you? Right?
Yeah. And I'll steal the tagline for our good friend John Chang, keep your eye on the horizon, and understand that there's always going to be pain along the way.
Yeah.
But learn from your mistakes.
And others.
and really when you feel that pain, look for the opportunity, because they usually go hand in hand.
Absolutely. Well, on that note, thank you very much for joining us today. We appreciate you listening. Like, follow for more, and we'll see you next time.
Thanks, everybody.
Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.